Hi everyone. Investing is fairly simple but not easy, especially in times like this when things are so uncertain and when one gets clouded by short-term narratives. So what I plan to share in this video is what we have learned from different cycles, what's our experience, and how investors could deal with these uncertain times when it comes to long-term investing. So there is one equation which investors should never forget. This is something which we have understood by dealing with these markets across many cycles. So what is this equation? This equation is all about the relationship between the prices and the uncertainties. Investors get the best prices when the uncertainty is the maximum. This is one equation which is played across the cycles. There is no exception to this, and this cycle is no different. So you get best prices when the uncertainty is maximum. But there is one challenge. How does one know uncertainty is maximum? You start to get investing, you start to get buying, but then the uncertainty could get worse. So there is no answer to this. One doesn't really know whether things will get worse from here or improve from this point of time. Only time will give the answer. This is where exactly one should take a longer term view and stick to one's investment process and focus on the future. So if you look at all the past macro challenges, every macro event had been a buying opportunity in hindsight. Please note, every event had been a buying opportunity. No macro event or macro risk had a lasting impact beyond few quarters. Whether it's boiling oil, geopolitics, or commodity inflation, whichever may be the narrative at that point of time, none of them had an impact beyond a few quarters. Even the worst global financial crisis didn't have an impact for more than 3 quarters. But the experts in TV panel would tell you investors should wait and let things settle down. Once the dust settles, they should start buying. In our view, it's not a wise thing to do, because it's very, very difficult for investors to time the bottom. What happens is, when the uncertainty goes away, when the visibility comes, the market moves so swiftly and so fast that investors end up waiting. So this is what practically happens, and we have seen this over and over again in the past cycles. There is no other option for investors but to start putting money, may not be at one single shot, but in a phased manner when things are uncertain. This is one equation that doesn't change at all. So how does one make this process easy? By taking a longer term view and ignoring the short term noise. At least to take a longer term view, as far as India is concerned, I think it's relatively easy. If you look at the India macro picture, in our view, the biggest tailwind for the economy is not anything to do with pent-up demand from pandemic or any temporary government capex stimulus or anything like that. The biggest tailwind for India is coming from two factors. So number one, the most underestimated cumulative base effect of very low growth or languishing growth over the last 7 years for India. The last time India grew beyond 7% is in 2014. From then the growth has been far, far below its trendline potential growth for many years. The second factor, which is again not discussed among the investment community much, is the cumulative impact of past difficult and painful reforms of this government, which is like GST, IBC, MPC and DBT, to some extent even DMON. So look at the numbers. The GDP has been growing much below trendline numbers since 2015-16, and the capex cycle is there to turn, and the manufacturing share of GDP has been languishing far below its potential trend line. So the good news is, with these reforms stabilizing now, the economy is likely to get the dual benefits, dual kicker of cumulative impact of these reforms and the cumulative demand impact from the last low growth of 7-8 years. So with clean up in corporate and bank balance sheets behind. It's question of time before the credit and capex cycle turns. This, coupled with turn in export cycle, real estate and property cycle, and commodity cycle, there are many sectors where investors can find new opportunities for structural play. There are certain themes which are likely to play out for a very long time in India where investors can find opportunities, like formalization, or one would call as consolidation theme, where market share shifts are happening from unorganized and small players to organized and larger players. This is a big theme which is it's been playing for last few, for a few quarters, and this will play out for much longer time for investors to find opportunities. Second theme which investors can look at is financialization, where the savings are likely to shift from physical assets to financial assets. This is another larger theme where there is, investors can find potential winners. So like this, investors can find, huge opportunities in themes like PLI, which is production linked incentives schemes, or in themes like China Plus One, where the global companies are trying to de-risk supply chains away from China. So there are many themes and sectors where investors can find opportunities for the coming months and years, given the strong economic momentum for India. So the other interesting thing is, what's happening from the FI numbers. Look at the data. It's very fascinating to see this resilience what the Indian markets are going through. FIs have sold close to about $16-17 billion, relentless selling from October of last year. Still, markets have not fallen so badly. Probably benchmark level you are down by 13-14% level, and even in portfolio levels, many portfolios have not seen erosions beyond 15%. Normally, when FI sells such huge numbers in the earlier cycles, if you go by this experience, the fall would have been much sharper in the portfolio level, beyond 25-30%. Why is this resilience? Why does one see such resilience in Indian markets? This could be probably because investors, the long-term investors, are seeing a lot more policy stability from this administration. Also, they are able to foresee the kind of economic momentum which I just talked about. Other thing is, in a way, it's a good news that markets have more or less discounted the taper cycle and the Fed interest rate hikes. What markets are yet to discount is to how far this geopolitical crisis can go. Will it be contained within one particular territory, or it can, will it become a wider conflict? That's not something which is discounted by the market. So how this plays out will probably determine how markets are going to trend in the short term. But the longer term picture is very clear to us. It's time to start putting money to work. Maybe not at single shot, but in a phased manner, given the strong economic momentum which we just discussed. As Morgan Housel says, all past corrections look like an opportunity, whereas the present and future corrections look like a risk. So with this, let me conclude this video. Happy value investing. Thanks for watching this video. See you in the next. Thank you.